Okay. Good evening, good afternoon. Hi, everyone. I'm Alex Meyer-Gohde from the IMFS, and it is my absolute pleasure to welcome you all today for a webinar that we have with Volker Wieland and Hendrik Hegemann, also from the IMFS, on the topic of price stability and risks. The subtitle Benign Outlook versus Potential Concerns. We're all experiencing right now, of course, a time with very uncertain outlooks and concerns. And we have sort of, you think historically, also connections to maybe underlying sources of price risks from previous decades, right? So the thoughts of oil pressures and concerns and how that might funnel into price stability is something that we've been thinking about for a very long time as economists. And there's a lot of course, interaction with fiscal responses to that. So we've got a whole broad spectrum, a big palette of different geopolitical threats and how that might interact with fiscal policy, fiscal decisions. And so it's a very timely and fantastic topic to be working on. I'd, of course, prefer more gentle waters for us to be talking about this in, but it is as it is. And I should also mention so that this research has been prepared as part of the monetary dialogue with the president of, or for the president of the ECB. So we've timely research here that's making an impact politically. So we're going to have a presentation here from Volker Wieland and Hendrik Hegemann. After the presentation, we're going to have a Q&A session. If you look in here, the Zoom, we have the ability in the Q&A for you to start typing questions in advance. If you see a question that you like, you can vote this question up. So that depending on, if there's a lot of interest in one particular question, we'll make sure that we address that question here after the presentation. So I think we should have everyone who's been waiting to come to the room has gotten in here. So with no further ado, I'll hand the floor over to our presenter. So the floor is yours, and thank you very much.
Thank you, Alex. So thanks for moderating this, and then also afterwards reading the questions and guiding us through that. So I'll have a few slides. I'll start out with some points, and Hendrik will conclude. We try to finish this in about 25 minutes, 30 minutes at most. So there's much time or enough time for questions. So let me share the presentation, which should be coming up now. And so Alex, is it visible? Is it in presentation mode? Yes. Okay, yeah. Great. Price stability and risks, benign outlook versus potential concerns. That was our title for this study here, which was requested for the monetary dialogue of the European Parliament with ECB President Lagarde. You can download this on the link here. It was published on February 23rd. It was for the dialogue on February 26th. And on February 28th, the world changed. And so I think that fits very well. And we're also going to address those changes. The message of our paper was basically that the ECB anticipates a benign and stable outlook for growth and employment, inflation, and interest rates with balanced risks. That's what they've been stating and writing about and communicating. And at the same time, Europe is faced with geopolitical threats, lack of competitiveness, major fiscal challenges. So on the one side, right, the president said we're in a good place, at least until recently. And on the other side, there's all this action. So it's obvious that significant changes are likely in happening all the time. Policies will have to change, even, if we hadn't gotten this energy shock. And the stable outlook, which they've adhered to, was always unlikely to be confirmed with subsequent events. That was our message. We said just going ahead and publishing wide uncertainty bands and claiming, oh yes, risks are balanced, it's just not enough. I think the ECB needs to consider dynamics of risk scenarios, worst case scenarios, asymmetric scenarios. They may be doing that in the background, but they're not communicating about it. It would be useful to communicate in different ways about it. And particular risk scenarios are those that arise from potentially misaligned or misperceived trends because we have data on that, or misperceived policy relevant parameters. And then one can illustrate how in a particular scenario one would be ready for a timely policy response. In our paper, we highlighted especially the risk of fiscally driven inflation due to the fiscal trends we have, unsustainable fiscal trends in many places. On top of that, now, since a few days after the dialogue, we have an additional asymmetric inflation risk due to a major energy shock. And if you remember, the last huge energy shock in 22 was also happening in a situation where we had very expansionary fiscal policy before, during, and for quite some time. So the overview for our talk, very briefly, we give you a little more information on the stable and benign outlook, the reality of challenges and risks. We don't need to give you much information. It's become very apparent. It's always been very apparent. We talk about what we meant, and we talk a little bit about the risk of the fiscally driven inflation as one of the scenarios. And we have additional material on top of what's in the study now to give a little bit more quantitative insight on the inflation risk and policy conclusions from the energy shock, at least what we can very roughly say after these first few days. In terms of the outlook, right here you see the data, what's been happening in terms of HICP inflation, very calm since 24, very close to the target of 2%. A lot of discussion this last year whether there would be an undershoot, but then the forecasts were revised up, no undershoot, and I think that undershoot now is really history. You see that most of the inflation we've been seeing, services here yellow, it's mostly food, it's mostly core inflation, orange non-industrial goods. The energy prices at most pushing it down. So the undershoot, which was keeping the ECB busy in its forecasting over the last year, the likely undershoot was driven by their assessment on energy prices, and that's not going to happen. So what did they look at in terms of core inflation? I mean, we talk about the outlook looking forward. Here you see this amazing stability. The blue line nailed, that's the latest forecast from December, nailed all the way into the future at 2%. We'll see if that comes to pass. Probably not. And September, there was this forecast of an undershoot even in core inflation. So not just energy, but they had to revise that back up. But if you think about the policy easing in June, the last policy easing, it was against the background of euro appreciation and the expectation of an undershoot sometime a year later or more. So they've certainly ensured on the easing side, I would say. But the main point here is extremely stable outlook. This is going to translate to a stable outlook for growth and interest rates, but very wide uncertainty bands. But everything, of course, systematically, the way you calculate these things is balanced, right? But whether it's really balanced is another question. In terms of interest rates, you see it here. Interest rates basically very close to inflation, a bit below, slightly negative real rates. So the relevant policy rate DFR at 2%. So here you see the stable outlook all the way into the future. There are always three numbers, right? Core inflation, GDP growth, interest rate. Can you see the arrow, Alex? Do you see the arrow also when I point?
Yeah, we can see the arrow.
Great. So that helps a little bit. Thank you. You see here 2.2, 1.22. So always like a bit more than 1% growth. 1.4% growth is, so that's their view of medium to longer term growth now in the euro area, and essentially stable inflation. And interest rates also stable, right? So a very good place, seemingly no need for policy change. Interest rates seen at essentially the same place as inflation, so a real rate of close to zero or slightly negative. And you can actually see there's wide agreement, right? The survey of professional forecasters was the same, right? 2%, 1.2, 1.4, 1.3 on growth, 2%, bit more than 2% on interest rates. Wide agreement. Can't we all be happy? Of course, that was before February 28, but even that's our point. Before February 28, there was no reason to give to these long-range forecasts any particular weight, because essentially, if you look at the past, we don't know much about the future. The ECB forecasts have no information. Probably most forecasts have no information beyond a horizon of, say, 3 quarters. You can, of course, feed these forecasts into policy rules. And, we've been doing these contributions to the multi-dialogue for a while. So we introduced different policy rules. I'm just going to show you one here. But of course, the policy rule will show you. So these are 2 different policy rules, Taylor rules, coefficient of 0.5 on inflation, 1.5 actually, because it's inflation plus the inflation deviation from target, and 0.5 on the output gap. That doesn't matter so much if the output gap is essentially closed, and if inflation is very close to target, then the only thing which matters here is the inflation once, right, plus the estimate of the real interest rate in the longer run, the equilibrium rate, the famous R star. And you see this Taylor rule is with an R star of 0.5. The light blue is calculated with the GDP deflator. The dark blue is calculated with HICP core inflation, which I just showed you. And it makes no sense to do a Taylor rule with HICP lead, the headline index, because that would have very strong reactions to the volatile components of inflation, such as energy prices. So that's what comes also out of the very practical implementation of these rules. But so, well, that looks like boring. You might say, what do the rules tell us on top of the forecast, which basically said interest rates could stay at 2%, inflation and output? Well, they tell us this would be consistent essentially with an R star of 0. Now, whether you want to believe an R star of 0 together with a potential growth of 1.4%, that's another question. That seems a bit unlikely. That's one of the asymmetric risks we could be talking about. We're not going to delve into that, though. But basically, there's a second point. You can use the rules, of course, when you do a risk scenario of another outcome or a worst case scenario, because the rules give you the reaction in other possible paths outside this seemingly benign outlook, right? So there is this reality of challenges and risks. And if you just look at the past, you see that it's quite common to have stable 1 year ahead forecasts. So these are 3 different forecasts. Blue is the SPF. Here, SMA is multi-analyst. Gray is the Eurosystem ECB staff projections. There are a few other ones coming here. And we compare that basically matching up the 1 year ahead forecast at the forecast date with the actual inflation rate happening at that time. So think of the inflation rate here being shifted or the forecast being shifted to where the inflation rate is that is being predicted. And you can see that always it's quite common that actual inflation would deviate from the forecast persistently, right? So much for the quality of the forecast. Persistent deviations at the 1 year horizon. So not only during the inflation surge, which you see here, right? And so here we are. So one lesson here is, well, don't give much weight to any forecasts, and policy shouldn't give much weight to the forecast 3-4 quarter beyond 2-3 quarters in the future. Of course, you should discuss risks. Now, how are risks being discussed? There's usually a long laundry list. Here is basically the inflation risk. In the paper, you can look at the other risks, growth risks. They're discussed in the ECB staff forecast, in they're not transcripts, but the summaries, right, which the ECB publishes for example, for the December meeting. There's a bit of discussion, of course, of the risk. The president talks about the risks, but the main message is always in line with the symmetry of the uncertainty around the forecast. Well, inflation and growth rates are broadly balanced. So that's basically, let's talk about risks, but then it's not going to matter. So we think this shouldn't prevent, although that's all technically understandable, this should not prevent the Governing Council from exploring the dynamics of particular worst-case scenarios in its deliberations. I assume they're doing that, of course. But if you read the summary we get, there isn't much in there. It doesn't go beyond a listing of the risks and that it's balanced, right? So I think these worst case scenarios should also show up in some of the communications, the summary of the meetings, for example, if they actually discussed asymmetric scenarios or worst case scenarios. If they didn't discuss them, they should start discussing them. And also, this could be discussed more in the staff projections. That's where you could put in quantitative work on these scenarios. Very rarely they've done that, but also the president could talk about it. And these scenarios may well turn out to give more weight to a particular direction of adverse developments. They don't need to be systematically, basically symmetric, as is the case with the probabilistic assessments, which are, always symmetric around the forecast. So in the study, we discuss how this could be done. For example, we talk about the interpretation of exchange rate risks, basically what I already mentioned, the past appreciation, first half of 25, which basically was one of the reasons for the policy easing. But behind that was a communication of an undershooting of the inflation forecast. Right? So that basically means they have already eased more because they had then, given the current forecast, which has been revised upwards, I'm talking about the December forecast, would imply. So there's already been some insurance on the downside. Anyway, R star, there is a divergence between the US and the euro area. In discussing that divergence, you might think, where is this equilibrium difference in equilibrium real rates coming from? Growth rates don't fully account for that, but probably also the fiscal risks, which are already more advanced in the US. So let me share a few notes on the fiscal risks. First of all, we think, or in our paper, we discuss that there is a systematic, a significant asymmetric risk of fiscally driven inflation. There isn't really much of a risk of fiscally driven deflation if you look at fiscal trends. The link between fiscal policy and inflation is actually well established. Right? To give you a Keynesian mechanism, fiscal policy boosts aggregate demand. This allows that firms to raise prices and wages. Government borrowing then creates demand for savings. Real interest rates have to rise. R star has to rise to accommodate that. And central banks, if they want to control inflation, need to raise policy rates to account both for the higher R star and to return inflation to the target. But there are other linkages, right? Because multi-policy has fiscal consequences. Central bank money creation gives seigniorage income. Inflation is a tax on the money holdings. Price level increase, and that's really interesting. We see that in a moment. Reduce the real value of the debt. And multi-policies affect the bond rates and the spreads. Higher debt may lead to higher inflation, either because inflation expectations rise in anticipation of future multi-accommodation, or because the increase in the price level itself reduces the real value of the outstanding debt. That latter point is a bit more the fiscal theory of the price level. The first point is a little bit more on fiscal dominance. Fiscal dominance is not a 0-1 concept. It could also be, by the way, a transitory concept where there is a partial or transitory fiscal dominance. I'll come to that in a moment. But basically, if we look at the data, first of all, if you look at the US versus the euro area still looks pretty good. This is the debt ratio. The debt ratio is rising. This is an IMF forecast very quickly in the US, going way above the peak from Corona. So the head of the Congressional Budget Office, which, if I'm not mistaken, was actually appointed by Trump in the President Trump in the first Trump administration, publicly stated that at the current trajectory, U.S. fiscal policy is not sustainable. Right, the U.S. government debt is not sustainable. So, how to resolve that? Inflation is one obvious way. You see that here. That was a debt increase during Corona. There was a recovery of Corona, but part of this decline here is thanks, in parentheses, of course, thanks to the surprise inflation. Even if it wasn't a surprise to everyone, the debt has, on average, 6-7 years duration. So a short-term increase in inflation helps you devalue some of that debt in real terms. You see that even more effectively in the euro area, but again, also here, debt is rising. Typically, deficits are higher in the US. So this is a big, beautiful bill, keeping it there. But also, if you look at the euro area, it's very different if you look at the diversity, the heterogeneity. We have a large share of countries, a large number of countries, which have greater than 90% debt. So they actually never reduced the debt after the financial crisis. They just stabilized on average around 110%. Then there was the peak here with Corona, the recovery, and there was the benefit on the devaluation of the debt ratio in real terms because price level grew more. And so the question is there a risk of these spikes happening again in the future? Because maybe that's one attractive way for governments, and not a good way, but maybe a possible way to deal with the debt. You see that both in terms of the average, but also in terms of the high and lower debt countries, the projection is that debt ratios will rise. This is particularly pronounced here in those countries. That's especially Germany. In Germany, the debt ratio will go up very quickly. So 80% by the mid-30s for Germany would actually be to be expected, or no surprise at all, maybe more. And here among the high debt countries, it's especially, for example, France, which is on a steep trajectory up. Interestingly, also EU members outside the euro area, they used to have lower debt. Some of them have now come into the euro area. They'll probably raise it quickly, but even outside the euro area. So one more point on this, there's a quickly rising interest burden. So this is not benign, this outlook. You can see here, this forecast from the European Commission goes out to 2035. This is for the large country here, Italy, France, Spain, Germany. And what this tells you is that the expenditure, the total expenditure on interest by the government in this case, as a share of GDP is rising quickly. And actually for France, it's way beyond the highest value they experienced since EU membership, since Euro area membership. For Spain, which had a high interest burden in the debt crisis, Euro debt crisis, it's already going above that level, right? This is the dots. For Italy, it's approaching that level, but Italy had a very high share of interest expenditure when they joined the euro area. So we're going in the late 30s for Italy, in the neighborhood of where they started. But of course, nowadays they don't have the same way of raising inflation seigniorage as they had before the euro. So this is quite tricky and quite challenging to deal with this interest burden. It would require a lot of consolidation, but it also means there is an incentive to inflate, at least temporarily, part of this away. And that's why there is a risk. And this is going to be a time where there's going to be risks of fiscally driven inflation. And now on top of that, we get the energy price driven inflation, and the fiscal situation in the background, the energy price shock on top makes this a particularly dangerous situation. So I hand over to Hendrik because he will show you some numbers here, or some results, or explain them to you. So Hendrik, I'll just, if you turn on your mic, I'll just click through for you.
Yeah, thanks a lot. Also good afternoon from my side. And yeah, let me start with the recent developments in global oil and gas markets. So yeah, please one slide ahead. Following the start of the war in Iran, we have seen noticeable increases in several energy prices. Oil and gas prices globally moved up immediately. At the same time, it's important to keep the magnitude of the current increase in perspective. In particular, gas prices in Europe and Asia remain well below the peaks observed during the energy crisis in 2022. However, the increases are still sizable. And if one looks at future prices, they suggest that market expects somewhat elevated gas prices in Europe and Asia to persist for some time. In contrast, the reaction in the United States has been more limited, reflecting the relatively strong domestic gas supply situation there. Oil prices have also increased, but future markets currently do not point to a sustained period of very high oil prices. In fact, today oil prices have already moderated somewhat, as expectations about the duration of the conflict have changed. Next slide, please. Can you please move ahead one? Oh, yeah, thanks. Yeah, to quantify the potential inflation implications of these energy price development, we use a Bayesian vector autoregression model for the euro area. The model includes 5 different energy price variables: gasoline, diesel, jet fuel, natural gas, and electricity, as well as headline and core inflation. An important feature of the model is that it focuses on energy prices that are relevant for final consumers. So, for example, the model includes prices for refined petrol products such as gasoline and diesel rather than crude oil prices, because these prices are closer to the final consumer prices and therefore more directly linked to the inflation dynamics. Okay, yeah, let's go one slide ahead. Using this model, we conducted a scenario analysis to assess how the recent increase in energy prices could translate into inflation in the euro area. The scenario is implemented using a conditional forecast. This means that we impose a path for energy prices for the first months of the simulation, while the remaining variables evolve according to the historical relationship captured by the VER. Coming to the scenario shown here. So we assume energy price increases that reflect observed market developments as of March 4 relative to the average price level in February. So gasoline prices increases by about 9.5% and diesel prices about 16.3%. That are data, we rely here on data for Germany. Jet fuel prices increased by roughly 80% based on LSGE data. For natural gas, the wholesale exchange prices have increased by roughly 50%. However, the model uses producer prices rather than this exchange prices. And since producer prices historically respond less strongly to movements in the wholesale gas markets, here we, according to historical relationships, assume that an increase of about 9.5% for natural gas. In the baseline scenario here, these price increases occur in March and remain at the elevated level in April. And after April, the model determines the subsequent evolution of prices endogenously. So that's the scenario. So we can now jump to the figures. The figures show the implied effect on year-over-year inflation under this scenario, and which is the additional inflation due to the energy price shocks. And the results suggest that the assumed increase in energy prices leads to a relatively strong increase in headline inflation, and the effects build up over several months and reaches its peak around early 2027. At the peak, headline inflation increases by roughly 1.5 percentage points, relative to a situation without these observed energy shocks. And core inflation rises a bit slowly, but peaks around 0.5 percentage points. It is also important to note that the results are quite sensitive to the assumed path of these different energy prices. If energy prices decline back to their February levels after, let's say, 2 or 3 months, inflation effects would become much smaller and only short-lived and less persistent, as one can see here. So in other words, the persistent inflation effects mainly arises if energy prices remain elevated for a longer period. Okay, next slide, please. What are the implications for monetary policy here? So first, energy price shocks create a strong upside risk for inflation. So one can question whether the inflation outlook is still balanced. So we think it's now asymmetric. However, monetary policy should not react mechanically to movements in headline inflation, since these may largely reflect only temporary energy price developments. If energy prices were to fall back quickly, inflation could or would likely to decline quickly as well. Instead, policy should focus on whether such shocks translate into sustained increases in core or domestic inflation. From a Taylor rule perspective, the appropriate response would therefore depend on more than one-for-one reaction to core inflation and on the broader macroeconomic environment, so taking into account also the output gap. And finally, it is important to consider that such energy shocks currently occur against the backdrop of the relatively expansionary fiscal policy in parts of Europe and the United States, as Professor Wieland already presented. You're still muted.
Okay, thank you. Yeah, let me add to that. Thanks. That's great. Yeah, I mean, we of course, I'm totally fine with that thing. It was very good how Hendrik presented it, and he already mentioned, and I just want to emphasize that on the one side, we have a pretty strong effect. If I click back, right, this is a pretty strong inflation effect, 1.5% on headline inflation. And there's one thing I wanted to add. Some of the discussions or questions I had from journalists or market participants, there was is a presumption now in Europe in money markets that there could be two 25 basis point steps in the policy in the euro area, the ECB policy going up. On the one side, our calculation, our scenario, I wouldn't. It's calculated at a forecast, but it's more like a scenario. There are a lot of assumptions, of course, going in. It would kind of justify such a prediction of 50 basis points move, because say if core inflation by early next year or mid next year goes up to 50 basis points, the Taylor rule would say 75 basis points response. So 50 is not outrageous. But on the other side, I would still say it's a pretty strong response, a strong assumption, or to think of this year two 50 basis points, two 25 basis points moves, because of the other scenarios we considered, in which Hendrik has mentioned, namely, what if prices would fall back to the February level within, say 6 weeks or so. Now, we may have very different assumptions on that, given how you're monitoring this crisis. And maybe one final point, I mean, Hendrik has also already said that, just to also push that point, I think it makes a difference whether you have energy price movements in a normal environment and then a kind of energy shock like just we have now, or if you have this happen in an environment where fiscal policy has been and is already very expansionary. I think the two things can work hand in hand, right? Because you have, on the one side, costs going up for production, and on the other side, you have fiscal policy supporting demand, and hence allowing companies to pass on the cost increases. If you think of diesel prices in Germany, for example, and the government now spending a lot on infrastructure, that means that, of course, these infrastructure companies, they will have to charge higher prices, and more of the money the government puts up will go into price increases. So without adding more, I think this has given you hopefully a pretty good view of how we think the ECB should use risk scenarios. The paper, so Hendrik's paper is or will be shortly available. It's a paper which gives you the model, which he's written earlier. He's worked on for a while. We actually have a bigger project going on, both with VAR models, but also structural models of the energy sector. So that should be available, or is available already, also for download. And we're going to prepare something in writing also for this scenario analysis, and we'll be updating that scenario analysis, of course, going forward. And you can imagine also in other settings that this is of interest both for policymakers and market participants. So I hope we can also get into more discussion about it. I hand back to Alex now.
Okay. Thank you very much, Volker and Hendrik, for the presentation. I've got a whole bunch of questions, but I don't want to monopolize the discussion here. We've got some questions here in the Q&A. The first question that's been upvoted the most from Hermann Remsberger. So given we have fiscally driven inflation in the US, stronger than the euros, you're showing, then what are the consequences perhaps for the US dollar as a reserve currency?
Well, very good question. First, before I talk about the reserve currency, let me say what I forgot to say is that I think a fiscally driven inflation also in the US also brings with it substantial spillover risk into the euro area. I don't think we will have a situation where inflation is only rising in the US and we have stable inflation in the euro area. We would be getting quite a bit of imported inflation pressure from there. I don't think we would tolerate, or the ECB would be willing to tolerate, an appreciation and its impact on inflation as Germany used to do, back in the 50s, 60s, when it was common for the German currency to be revalued. And then when the currency became flexible, right, we had a lot of appreciation when the US had higher inflation. I mean, that look back also helps us to answer your question about the reserve currency, because if you think back, when people ask me about how will Trump's policies affect the reserve currency role, I always say that I think the comparison to Nixon is of interest. It's of greater interest than going back to the 30s, which others have suggested. Nixon basically also changed the role of the US dollar. Remember, it was part of the Bretton Woods system, and that gave a very prominent role to the dollar. There wasn't so much capital mobility. The capital mobility came over time. But then the US also became important, of course, as a reserve currency because of that system and that central role of the dollar in the Bretton Woods standard. Now, Nixon basically ruthlessly torpedoed the Bretton Woods standard. He said, well, that's not working for the US. So, he didn't say make the US great again or make America great again, but it has a lot of the same flavor. He said, we have to do something which works for America. That led to a flexible exchange rate system that led to attempts in Europe to control exchange rate movements here. It also led to inflation, right? Together with the oil shock in the 70s. So same story, right? You had expansionary policy, you had the oil shock, you had inflation, all that came together. You had at least a lot more inflation in the US than in Germany at the time. You had D-mark appreciation. But all that did not lead to a demise of the US dollar as reserve currency. Why not? Simply for a number of other strategic reasons. He basically made sure the petrodollar market became a petrodollar market, right? So the dollar, Nixon was very active in getting the diplomacy going to have petrol prices, oil prices tied to dollar and basically quoted in dollar terms. And then also he was very supportive of the creation of the euro dollar market, basically putting dollar, so it's going to be a long answer, sorry, but putting dollar reserves, dollar accounts and dollar borrowing in London, right? So states who didn't want to transact in the US, say Russian money, oil money, could flow to Europe, could flow to London, but be there in dollars. And the regulation was adjusted, and this was actually supported quite favorably by the US. And so that conjunction, the euro dollar market, the pricing in dollars, all that helped maintain the reserve currency role and generally the central role of the US dollar in the international system. And I think we have a similar situation now. Trump torpedoing basically our trust into the US government debt, right? You see that basically they're not doing anything at the moment to this exploding debt ratio. I mean, eventually, of course, particularly after the next election, they might find it hard to raise the debt ceiling. So we're going to have maybe another situation like that. But in principle, he's not taking the necessary steps to stop the rise of debt, but he's taking the steps to expand the use of the US dollar internationally. Think of the stable coins, right? He's pushing legislation to promote the worldwide use of US dollar stablecoins, regulated according to US regulation, right? And being done by US institutions and other institutions, but they have to be regulated by the US, and they will have to use a lot of US debt, government debt, or other US assets as reserves to issue the stablecoin. Issuing stablecoin is also a nice business because stablecoins have a zero interest rate. So you can basically hold almost anything. And also under high inflation, high interest rate US debt and make a nice profit. So my long-winded answer, Mr. Remsberger, is this is not going to torpedo necessarily the reserve currency role. We have to compare to Nixon. And I think it's worth mentioning, Hendrik, at some other point, we actually prepared in October a report on the role of the euro, the international role of the euro, moment of the euro question mark, also for the multi-dialogue. And at some point in the future, maybe we do a presentation on this together with maybe the question of Eurobonds. Hendrik, do you want to add anything?
I think it's totally fine.
Okay, other questions?
Yeah, so we have a question from Nicholas Ganot. So to what extent do you think the current macro environment is different to 2022? Like, what are the key differences? And specifically, what do you think about the risk of higher energy prices transmitting into core inflation compared to back then?
Let me say a few words, but maybe Hendrik also, maybe you can speculate about what running the models would say because the cool thing about this was that these were estimated comparing data before the last surge and data with the surge, right? And that changed the mechanics. But I think what's very clear is that in 21, core inflation was rising. Right. So actually, in 21, core inflation was rising before the energy shock. Right. And so in that sense, it was worse because so far core inflation is not rising. So in 21, core inflation, domestic inflation was rising. It was just being ignored by monetary policy. It was rising because we had this extremely expansionary fiscal and monetary policy in Corona, and we did not take back the supportive effect of expansionary demand-side policies when the economy was recovering. We kept all that in place. The ECB kept buying assets, kept interest rates on negative levels. The fiscal support was basically kept in Europe, in Germany. We kept the very generous short-time work arrangements and other stuff, other support. We were very, very reluctant to take any of that back. And so I think hopefully what is different now is that core inflation is not yet rising. And back then, when basically in February 22, it was already clear that inflation and core inflation had been rising. And we already had 5% inflation at the end of 21, and we had the ECB explaining to us that this was the peak and there was no need to respond, and they had kept the interest rate at negative levels. So the ECB is much better positioned now as then. And so I don't think we should be equally worried for a number of reasons, because the energy shock is not the same. I think Hendrik was very clear on that, and the data is clear on that. But Niklas, I should mention Niklas. He was actually our general secretary at the Council of Economic Advisors of Germany back then. In one thing, I'm not saying, or no, maybe it was still Wolf and you became it later. Maybe I'm mixing that up. But you were at the council and working with us. I had a hard time getting my colleagues in 22 to actually worry about that high inflation. And the feedback I saw in the end, I basically gave some interviews in the press and said, look, ECB should proactively do something as inflation is rising. And I did that. I started doing that in March 21. But basically, my colleagues were saying, look, the ECB says it's okay. So who are you to say? But I think by now the ECB has wised up, and I think they're not going to delay a reaction as much as back then. At least I hope not. Hendrik, do you want to say something what the empirical analysis says?
Yeah, I can say something, or also speculate a bit about the future, about this shock, because I think in 2021, 2022, we saw more of a structural change also in the energy market. So for the gas market, it was more like that probably the pipelines between Russia and the euro area shut down for the foreseeable future, and Europe had a relatively hard time to replace that kind of gas. They switched more strongly now to LNG gas. while the shock now seem to be more temporary. So it's once it's again it's possible to ship again LNG and oil again to Europe or to Asia. I think then the effects will disappear relatively quickly. So we do not see a structural change in the energy markets as we have seen before. And yeah, I think therefore the shock will probably be much more temporary compared to what we saw in 2022.
Okay. We have two questions related to AI, and I'm going to bring them together. So, Nice asked regarding AI or quotes that Isabel Schnabel suggested in a recent speech that regardless of whether AI boosts supply or demand, the monetary prescription is the same, rates higher. And Heinrich Pessens asks about the energy impact from AI. So is this going to make these AI a shock, like an energy shock, or is that somehow accommodated?
Yeah, very, very interesting. First of all, before we look at the energy component of that, well, we're still uncertain how AI will really impact things, right? There are very extreme scenarios, right? From extinction to growth without having to work. But in the simple macro analysis we usually do, I mean, in the normal sphere of things, right? We would say AI will boost potential. And so first of all, if you think that demand doesn't react right away, so it will push supply above demand, and that will be deflationary or disinflationary, right? So, right, so you have a negative output gap then. So yes, Schnabel may still have a point, but it really one has to see how it works out quantitatively, right? Because of course the other thing which increasing supply does, it would also boost the equilibrium real rate. So if you approach this from a Taylor rule perspective, you would have a negative output gap. If you have the right measure of potential, if you actually get that right, that's another question, the uncertainty about potential. You'd have a negative output gap, but on the other side, you have a higher R star, and you have to balance the two things. And of course, what tells you a bit more about what's really going on when you look at the actual inflation move, right? What actually happens in inflation, how that pans out there. Because on the demand side, right, the AI means there's a lot of demand, right? They're basically on the one side to put the AI in place to develop the next model, you need a lot of energy. So these companies are borrowing like crazy. There's a huge amount of borrowing to build up this energy production, these power stations. And then also there are big gains in stock markets, or they have been, right? So people are wealthier. That also has a demand effect, right? So it all plays together, and quantitatively, on balance, I would say it's not wrong. But at least if it's mostly on the supply side and not so much on demand, then it's not so clear whether it means higher rates. But in terms of the balance of risks, I mean, as you've seen from our talk, I think, yes, definitely the balance of risks is on the upside. And although we didn't elucidate on that, but we think there, even before February 28th, there were some good arguments to be made comparing the policy easing, which happened in the euro area, which went much further than the US. The appreciation was part of the reason, and the undershooting forecast. And certainly the undershooting forecast was already history in December. So they kind of insured a little bit on the downside. So policy is already very easy. And I think that gets reinforced by the point in R star. I think having an R star of 0 and at the same time thinking AI will change the world and will make us grow a lot doesn't fit together. So there's another asymmetric risk maybe. So all in all, I think we have to worry more on the upside in terms of rates. And the ECB hopefully is catching on to that now. On terms of energy, yes, well, that means even more reason for AI to grow and to help grow the economy in places where energy is cheap. So even bigger challenge for a place like Germany. I hope we can rectify some of the mistakes we've made in terms of energy supply policies. One obvious one is that we didn't do long-term contracts on LNG. Another obvious one was the getting out of nuclear power, right? Hendrik.
Yeah, I do not have much to add. I mean, if AI drives up energy demand and thereby we see rising energy prices due to then more growth, that is usually more easier for the central bank to to fight this kind of inflation coming from a demand shock.
Okay, I have two questions here related to inflation risk in particular. So one question, and so if we have inflation risk, a risk premium that might be around, is this perhaps related not only to simply fiscal policy risk, but also economic policy uncertainty? I mean, so thinking maybe about nonlinear effects here. And then a more specific policy-oriented question that was from Lucian Orlovsky and from Jörg König. We have the question, so given that you've shown it's difficult to forecast inflation rates accurately and that fiscal policy poses high inflation risks, should the ECB change its definition of price stability to a lower target range, perhaps 0 to 2%, so maybe return to the previous asymmetric inflation price stability definition?
Well, I like the earlier definition, below 2, because it actually was quite helpful during the period of low inflation. But at this point, I wouldn't recommend going back to it. Because I think it's not good to change, to basically keep changing the target every 5 years, or might do these reviews every 5 years. Okay, I see my video turned off. I'm turning back on. Okay, but I think you're making a good point, Jörg König, right? That this makes it important not to rely on these medium to long-term forecasts. I think the ECB in the inflation surge, and actually the Fed also, I mean, they were much too focused on these long-term forecasts, which have no information. Other than saying, okay, if we don't know anything about the future, we assume that the ECB or the Fed will do what's needed to get inflation on target, right? That's why people then pencil in a 2% on the long run forecast. But I think it's a very strong argument for focusing on actual inflation as we can observe it. Not on headline, right? Not immediately on headline just because it moves around in a volatile way. But certainly when core inflation rises, when domestic inflation rises, right, where we take out the import prices, but where we have the government sector and investment goods and all that and construction fully in, right, that's not in to a full extent in the consumer prices. So if we see inflation rising in those measures, the ECB or the Fed should respond, right? And that was, I think, the main mistake, what caused the delay in 21, and hopefully I think they're sensitive to not do that again. But at the same time, I'm not calling now for immediate tightening just because of the energy price increase. We have some immediate possibility for reactions on the energy policy. On the inflation risk premium, Lujan Orlovsky, I see you're referencing your own work with Eichenbaum. Actually, I have to read that. It's a new paper. But in your question, you're saying monetization of inflation is no longer possible due to excessive debt. I'm not sure. I think the incentive to have another round of temporary inflation, maybe not 10%, but 4 or 5%, the incentive is quite strong, right? Kind of, oh, there was a shock. We couldn't do anything about it, right? And we bring it back, right? I mean, when you listen to central bankers, they are very keen to say, Putin, it was the Putin shock which drove inflation up. We couldn't do anything about it. but controlling inflation and bringing it down, they claim a lot of responsibility for that. And of course, if policy had an effect on the decline, getting the decline of inflation, it also had an effect on the rise of inflation. But in any case, these temporary surges of inflation help control the real value of the debt. So there is a temptation, and that temptation, I think, will accompany us over the next year as we have this energy shock, but actually over the next decades because of the high and rising debt.
Okay, I think this kind of ties into this next question. If you think about the asymmetries that you pointed out, these upside risk and inflation. We have this here, the question that you just answered about inflation risk and this upside risk of inflation. You could think also more broadly about challenges to modeling and maybe improving these forecasts that you showed were not very good from the ECB. But how can we capture perhaps these distributional points? One question here from Bodo Herzog asks whether these so-called heterogeneous agent New Keynesian or Hank models should supersede these traditional representative agent DSG models in informing ECB monetary policy.
Well, actually, this is not what I think is a good question in terms of modeling. Let me take it a little further. There was this idea that central bankers, researchers in central banks didn't have good enough models, and they basically and the forecasts were wrong because of the models. I'm not a big supporter of that idea. Yes, we know that forecasts were wrong across the board. Also, forecasts of the model of the people who don't use models. By the way, I think we actually have some research on that, which I hope to be able to talk about in more detail soon. If you really take a serious look at what forecasts available structural macro models would have produced during the inflation surge, those models did actually better than some of the ECB, Fed, or survey forecasts out there. So at least they responded more quickly to the rise in actual inflation. So I think, my story or my understanding of what happened was there was also a strong conviction, we haven't seen inflation for so long, that basically at the very top of central banks, the policymakers, they didn't believe that there was inflation coming, that there was any inflation risk. They didn't believe expansionary policy would lead to inflation because there hadn't been inflation. They were fighting, low inflation rates for more than a decade. And so they kept saying, well, we have to wait. Remember, the ECB even announced that they want to have an inflation overshoot. That was their strategy, the result of their strategy review published in 21. And yes, we got the overshoot. Thank you. But that wasn't, I think it's too easy an excuse to say, it was also ECB President Lagarde had a statement which was not very flattering to the ECB staff. They said they're tribalists, they're tribal, these economists. They're in groupthink. That's what other people said, groupthink. She said tribal, and she said our models were wrong. They led us astray, right? She regretted sticking with the policy too long. And the regret, I think it's courageous and good from her to say that she regretted that. I think that's well justified. But the statement that this was the tribal model builders, economists in central banks who caused this, I think that's not a sufficient explanation. The models we have, so the rank models or the two agent models, right? To have a lot, like the models the ECB staff was using, they, depending how you use them, they gave pretty good. They didn't totally lead the ECB astray. I think there was also potentially a lot of reluctance to adopt another view on the top, and then if that's the situation on top, then basically you can't expect the staff easily to change their minds. So anyway, but I hope to back that up within a future paper looking at model-based forecasts. And of course, yes, Hank models, which look at the heterogeneity, they are very good at looking at effects on inequality, on distributional effects, who basically is a winner, who's a loser of higher interest rates, who's a winner and loser of lower interest rates. You can get the effects on Gini coefficients and all that. So a lot of new results you can get from that. But I'm a little bit of I'm not as convinced that they would help us forecasting on the time series. But we'll see. I mean, so I encourage you to make them more tractable and easier to put. We have this big archive. I think it'd be great to have a Hank archive, but they have to be, you have to use versions where they can be more easily replicated and simulated.
And I think on that note, we're just 1 minute over time, but we've answered all the questions and gotten through a fantastic presentation. So let me thank, of course, our attendees for coming and participating in this presentation and putting together or posing such varied and also interesting questions. And also, of course, then to Volker, Wieland, and Hendrik Hegemann for the presentation. So it's been a pleasure on my side, and I look forward to seeing everybody at another webinar from the IMFS sometime soon.
Yeah.